Assalamu alaikum class. We have completed the microeconomic portion of our course. Now we've moved to the next portion of our course, and that's macroeconomics. So from chapter 19, we are going to take a look at the concepts and an overview of macroeconomics. Macroeconomics, we have discussed the definitions in the definition in the beginning of our course, that it studies the overall behavior of an economy. That is, when we're observing the behavior of consumers, firms, and workers at the same time. Rather than focusing on single behavior at a time, when we're observing all the behavior or the behavior of the overall economy or the whole economy at the same time, is the macroeconomics. For example, when the price increases, quantity demanded decreases. Up till now, we are restricting our study to this behavior: higher price, lower quantity demanded, law of demand. But we do want to know that when the demand decreases, how it can affect all other interrelated variables. So when the quantity demanded reduces, supply is going to be reduced as well, and it results in lower output as well, because if the product is not required by a consumer, its supply and output gradually decreases. Lower output always affects the employment level. There is a direct relation between output and employment. If the output decreases, employment decreases as well. Employment decreases, it means that when people are out of job, income is going to be reduced, and that affects the national income of the economy. So if we restrict ourselves to only price and quantity demanded, it is micro. But if we want to include all other variables at the same time, it is turned into macroeconomics. When we observe price and quantity demanded, consumers, supply and output, firms, and then employment and income, that affects the workers' behavior at the same time. Now, there are three basic goals on which the macroeconomic focuses. First is output, second is inflation, and third is growth. So we are going to take a look at these three basic goals one by one, starting with output. There's a positive relation between output and employment, or a direct relation between output and employment, that as the output increases, employment is likely to be increased as well. Or if output reduces, employment is going to be reduced. Macroeconomic policies are used to control or influence output and employment in the economy. So we do want to know that how the policies work. So when we talk about macroeconomic policies, normally there are two policies which are used in any economy to attain the goals. It is either a fiscal policy or a monetary policy. First, we are going to start with the fiscal policy, that how it can be used by the government to attain its goals. First one is fiscal policy. Fiscal is operated by the government by controlling government spending and taxes. There are two tools through which the fiscal policy is operated. It is either by using the government spending, which is denoted by capital G, or the taxes, which is denoted by capital T. First, let's take a look at the government spending. Government do the spending either on the development expense or on the non-development expense. Development expense, it means that infrastructure, that whenever a new asset is created, it could be in the form of the roads, motorways, dams, metro, all these are considered as the development spendings, because in that case asset creation has been done, or a new asset is created for the economy. Non-development spending includes defense expense, debt repayment, expenses done on the renovation of government buildings. All these are the non-development expenses by the government. A government has to do both these expenses, but over here mainly we are focusing on the developmental side, or the development expense. Then comes the taxes. Taxes, these are the source of revenue for the government. It can be the direct taxes or it could be the indirect taxes. I hope that you have an idea about direct and indirect taxes. Direct taxes which are directly imposed either on the income or on the property or on the wealth. That is income tax or the wealth tax or property tax. Indirect taxes which are indirectly imposed, for example, GST, general sales tax, or custom duty or the import duty or different surcharge which has been charged by the government. These are all the examples of indirect taxes. Now, by controlling the government spending and taxes, government observe the fiscal policy. So we are going to observe both these tools one by one, that how these can be used to attain the macroeconomic objective. Remember that we are discussing the topic of macroeconomic goal, and that's the output, and how the output can be increased or decreased. For that we are observing the fiscal policy. So we observe or we assume that the government announces a new project, which means that the government spending is going to be increased. It could be any project. Let's say it could be a motorway, it could be a dam construction is started, or a new building project started. It is spending on the part of the government, but for the economy it is considered as an investment because a new asset has been created. So higher government spending leads to higher investment. When the investment increases in the economy, production process starts, or production or the output increases. To produce more people are required, so the employment level gradually start increasing, which results in higher income. Higher will be the demand and higher the prices. So over here, when the output and employment both are, you observe that government spending increase, output increase, employment level increase, which means that government has used the tool of our fiscal policy to increase the output and employment. But it could be possible that the government announces a decrease in spending as well. Let's say that in a budget, the government announces that there will be no new projects in the budget. So it means that government spending on developmental projects is reduced. So when the government spending reduces, it means that all other variables are going to be showing the downward trend as well. It means investment is going to be reduced, lower spending, lower investment. Output is going to be decreased as well because production process is going to be affected as no new project is started. Output reduces, it means employment level reduces, people are out of the job. Income of the people decrease because employment is decreasing. When people do not have income, they do not have the purchasing power, demand is going to be reduced as well, which means that prices are going to be decreased. So it means that decrease in government spending has a negative impact on output and employment level. So if we observe over here, higher government spending increases output and employment, but if the government spending reduces, output and employment is going to be reduced. So we have taken a look at the first tool of fiscal policy, which is government spending. Now we are going to take a look at the second tool, which is taxes. In the same manner, if the government announces, let's say, a reduction in tax to encourage investor in market, whenever the tax is reduced, it means that lower cost for the investor, so it encourages investment in market. So when the tax reduces, investment is going to be higher because cost is reducing for the investor. Output increases, employment increases, income, demand and prices all are increased. So this time, instead of government spending, we are observing the effect of tax, and the rest of the variables are the same. Again, higher investment encourages higher output, which means more people are going to find the job. Income of the people are going to be higher, which created demand, and prices are going to be increased as well. On the other hand, if the government announces a new tax or increase the tax. Either the government announces the new tax or increase the tax rate, the impact is going to be the same. So higher tax means investment is going to be reduced because the cost of doing business is increasing, which discourage the investor, so investment reduces. That means that output or production process slows down. No new employment generation, employment level is going to be reduced, income of the people is going to be decreased, buying power, the purchasing power is affected, demand decreases, prices are going to be reduced. So in this manner, when the tax is going to be increased, output and employment reduces. However, in case of lower tax, output and employment increases. So again, either by using the government spending or by using the tax, output and employment can be controlled. So over here, instead of using one of independently discussing the taxes of the government each time, we are going to say that the higher government spending and lower tax has the same effect. So in either case, if the government spending increases or the tax reduced, output and employment increases, and we will consider it as an expansionary fiscal policy. Expansionary means that when the government intend to expand the policy or expand the economic variables. However, if the government spending reduces or the tax increase, output and employment are going to be reduced, and that we say is the contractionary fiscal policy. So rather than using the term of higher government spending or higher tax, we are going to use the term of expansionary fiscal policy and contractionary fiscal policy. Expansionary fiscal policy means either the government spending is increased or the tax is reduced. Contractionary fiscal policy means either the government spending decreases or the tax is going to be increased by the government. So contractionary fiscal policy reduces the output and employment, while expansionary fiscal policy increases the government spending and tax. Then comes the second policy, which is monetary policy. Monetary policy, it is operated by the central bank of a country. Each country has its own central bank, which is responsible for the regulation of money supply. And how the monetary policy is operated? By controlling money supply in an economy. So let's first take a look at what is meant by money supply. Money supply is the circulation of money in an economy, that how much money is circulating. And to control the money supply, different tools are used by the central bank. These are either the open market operations, required reserve ratio, and discount rate. Let me give you a brief introduction of these three tools which are used to control the money supply. Open market operations, or we call it OMO as well. It includes the sale and purchase of government securities, which could be the T-bills. Central bank buy or sells these security from the commercial banks to control the money supply in an economy. For example, if the central bank purchases the security, it means that security will go to the central bank and cash will go to the commercial banks, which increases the cash reserves of the commercial banks. It means that banks have more money to lend and money supply is going to be increased. On the other hand, if the central bank sell the securities, which means that now the securities will move to the commercial banks and cash will come to the central bank. That reduces the cash reserves of the commercial banks, which means that banks have now less money to lend and money supply is going to be reduced. So it means that if we are following the open market operation technique, if the securities are being sold, then it reduces the money supply. However, if the securities are being purchased by the by the central bank, money supply is going to be increased. Then second is the required reserve ratio, or we call it R cube as well. By law, each commercial bank has to keep certain ratio of the reserves in their vaults or at the central bank. And that ratio is determined by the central bank. If the central bank wants to increase the money supply, it is going to reduce the reserve ratio. So if the central bank reduces the reserve ratio, it means that banks have more amount or reserves which is available for the lending purpose, and the money supply increases. Let's say that central bank announces that out of 1 lakh, 10% each commercial bank has to keep as a reserve ratio. It means that out of 1 lakh, 10,000 will be kept as a reserve ratio, and the remaining 90,000 will be used for the lending purposes. On the other hand, let's say after a while central bank thinks that there is a need to control the money supply, and reserve ratio, instead of 10% it is increased to 20%. So it means that out of 1 lakh, now 20,000 will be kept as a required reserve ratio, and 80,000 will be available for the lending purposes. So if the central bank increases the reserve ratio R cube, it means that commercial banks have less money available in their for the deposit or for the lending purposes, which reduces the money supply. And then comes the third one, which is discount rate. Discount rate is the interest rate at which the commercial banks can take loan from the central bank. Now, if the central bank increases the discount rate, the lending ability of the commercial bank decreases and the money supply decreases. Let's say that it means that, let's say that if the discount rate is 10%, after a while that discount rate is reduced to 5%. It means that when the commercial banks took the loan from the central bank previously, they are paying more because it is 10%, so the lending ability is going to be decreased as well. But now central bank wants to increase the money supply, and it reduces the discount rate to 5%, which means loans become cheaper for the commercial banks. Now they have more lending capacity, which increases the money supply in the market. So these are the three tools which are used to control money supply and through which monetary policy is observed: open market operation, required reserve ratio, and then discount rate. So over here we are going to observe only one of the technique, and that's the open market operation. We are focusing only one of the technique, open market operation, that if the central bank announces the purchase of T-bills using the open market operations, or you can say announces the purchase of government securities using open market operation, it means that the security will go to the central bank and cash reserves will move to the commercial banks. That increases the money supply. When the money supply increases, interest rate is going to be reduced. There is a negative relation between money supply and interest rate. Whenever money supply increases, interest rate is going to be reduced. Lower interest rate means investment is going to be higher because the cost of borrowing is decreasing for the investor. Cost of borrowing is interest rate. The lower the interest rate, the lower will be the cost of borrowing, more investment done in the market. Higher investment increases the output, increases the employment level, income, demand, as well as the prices. The rest of the variables are the same, which we observed in case of fiscal policy, but over there we have taken a look at the government spending and tax. Now we are observing the effect of money supply, and that's monetary policy. Lower interest rate, let me explain it again. Lower interest rate because the money supply increases, it encourages the investment, output or the production increases, new employment generation occurs in the market, income of the people increases, demand increases, price increases as well. However, if the central bank announces the selling of T-bills using open market operation, that the process is being reversed. It means that now the cash will move to the central bank and securities will move to the commercial banks. That decreases the money supply in market. Lower money supply means higher interest rate because there is a negative relation between these two variables. Higher interest rate, it discourages the investment in the market because cost of borrowing is increased due to higher interest rate. Production reduces, no new employment generation, income of the people decreased, demand decreased, prices are going to be reduced. So it means this time all the economic variables are showing a downward trend because money supply in the market is reduced. Now again, using each time that how the money supply increased or decreased, we are going to use a term of expansionary monetary policy and contractionary monetary policy. If the money supply is increased using the open market operation, it increases the output and employment, and we call it expansionary monetary policy. However, if the money supply is reduced, which reduces the output and employment, we will call it contractionary monetary policy. Again, the term states it very clearly. Expansionary monetary policy means that when the central bank wants to expand the economic variables, and that's through increase in money supply. Contractionary means when the central bank wants to control the money supply. So over here the money supply is decreasing, so output and employment are decreasing as well. So fiscal policy is operated by the fiscal policy operated by the government by using the taxes and government spending. Monetary policy is used by the central bank by controlling the money supply. So first goal of macroeconomics, output, either by using the monetary policy or by using the fiscal policy, output and employment can be affected. How? The procedure we have just discussed. Then comes the second goal of macroeconomics, which is inflation. Inflation, let us first define it: consistent increase in overall prices. Price stability is one of the major goals of any economy, and to control inflation, monetary and fiscal policies are being used. Now again, same monetary and fiscal policies are being observed while to control the inflation. For example, the government want to control the inflation, and for that purpose it announces a contractionary fiscal policy. Contractionary fiscal policy, we know that either by reducing the government spending or by increasing the tax, which means that investment is going to be decreased, output decreases, employment decreases, income decreases, demand decreases, and prices are decreasing as well. Now when the prices are decreasing, it shows that inflation rate is being reduced, right? So over here this price variable is indicating that inflation. Now it is, when we observe over here, it shows that due to decrease in price, output and employment and income all are decreasing as well. Now it is the economy's choice or the government choice that which goal is more desirable. If the objective is to control the inflation, then for that, to control the price, the cost which the economy has to bear is lower output and lower employment level. So it is the economy's choice, or it is the government choice that which goal is more desirable. However, if the government or if the central bank this time wants to control the inflation, and for that purpose it was again going to announce the contractionary monetary policy, which means that contractionary monetary policy means that open market operations tool which is used is going to be the selling of T-bills, which means that the securities will go to the commercial banks and cash reserves will go to the central bank. Money supply is going to be reduced. When the money supply decreases, interest rate is increased, which discourage the investment in the market because the cost of borrowing is increasing, output decreases, employment level reduces, income decreases, demand decreases, and again price decreases. Now, when again the prices are reducing, we said that this is the inflation which is being controlled by the central bank. So either by using the contractionary fiscal policy or contractionary monetary policy, inflation can be controlled in the economy by government. Then comes the third goal, which is economic growth. Economic growth, it is defined as increase in productive capacity of an economy. Productive capacity, you are already familiar that it shows the how much economy can produce, and it depend upon inputs and technology. So you are familiar with these two variables as well. Inputs, that it shows all the resources, and technology is the method of production. So if the inputs are increasing or technology increases, productive capacity increases, and that lead to higher growth rate. Impact of the growth can be observed through the improved living standard of people. Whenever economic growth occurs, living standard of the people improve as well. But how the growth can be attained? To attain the growth rate or to increase the growth rate, it depends upon the investment rate. If the investment rate in the economy increases, growth rate is going to be increased. Better and improved industrial policies, that if the government is supporting the industry by introducing better and improved policies, that also accelerate the growth rate. And then technological development, that innovation, research and development also increases the growth rate of an economy. So these are the three basic goals on which the macroeconomic focuses. It is either output, second is inflation, and third is economic growth. And for the first two goals, monetary and fiscal policies can be used to increase the output and employment or to control the inflation. And for the economic growth, the focus is going to be on the higher investment rate and better industrial policies, and that results in improved living standard of the people. So over here, first topic of chapter 19 is completed. If there are any queries, we will discuss it in our live session. Thank you and Allah Hafiz.